Hey everyone, happy Thursday, April 20th. It is just before noon on the West Coast, and it's time for another market update. Looks like spring is still taking its time to get here in Central Oregon and on the West Coast. It's snowing outside my office right now. It was basically blizzard-like conditions yesterday. But looking ahead next week, it looks like sunny days. Next week is our Camp Eagle Cap charity golf tournament for my company, and that's happening, so it's great to see we're going to have some sun. Last week we were heavy on inflation and jobs data. This week it's heavy on housing news, which is always important to take a look at. So leading off, we got builder news, starts, permits, and HMI. We always want to take a look at starts and permits because that's a pretty good indicator of future inventory. And there's a trend in this data if you take a look. The month-over-month data for starts are all down. If you look at permits, starts, and completions are all negative. But if you look at single-family starts, which we all want to take a look at, those are all positive. So single-family starts were up 2.7, permits were up 4.1, and completions are up 2.4. So, builders are on it. Builders are seeing there's not a lot of inventory out there, and they're getting more confidence. And that feeds into this one. This is basically their confidence index. And as you can see, builders were very confident, going back in 2021 and starting, when things started to slow down, that started to go down, and it's kind of hit its low in December, and it's been on an upward trend ever since. So that's good to see. Builders are doing well. We like to see that. Next thing we got was March existing home sales. So down with an asterisk. So basically, they're down 2.4% month over month, but last month was up 14%, and they made a positive revision to that. They added even more upwards trend. So, compared to that, original numbers, they're only down 1.3%. So keep in mind, month over month is always compared to what came before, and last month was really hot. Still down 22% year over year. Median home prices were up 2.2% month over month and down a little under 0.9% year over year. Median is not the best indicator, but it, down only, under 1% year over year is not a huge drop, not a crash for sure. Looking a little closer, we got inventory still around 980,000 units for the third straight month, very low compared to 2007. 2007, there was 4 million existing homes available. So big difference between then and now. So about 2.6 months supply. A normal market is 4.6, so still very tight with existing homes. Days on market down from 34 days to 29 days. So good to see things picking up. Things are going faster. Good for our industries. 65% sold in less than 30 days. That was up from 57%. First-time home buyers ticked up 1% to 28. Cash buyers down 1% to 27, and investors down from 18 to 17%, but still about one of every 6 transactions. The next thing we got was initial job claims. So initial job claims, something we keep an eye on, new unemployment claims, because we know the Fed is looking at this. They were up to 245,000. Expected was 240,000. And continuing claims were up again as well. So that shows people are having a harder time getting a job once they do get laid off. The 4-week average of 240K is the highest since, I believe, November 2021. So this is something we want to keep an eye on. We don't want this to get too crazy, but it might need to get there to get the Fed to back off, because it seems like they're kind of intent on causing an employment recession. They don't say that, but in everything else, it seems like that. The next thing we got was purchase apps. Purchase apps were down 10% from last week, down 36% year over year. Rates didn't have a good week last week. I think we went from 6.18 to 6.42, and purchase apps were down. That's that correlation has been pretty obvious. When rates come down, apps go up. When rates go up, apps come down. So where did that leave us? Last week, like I said, 6.42. Now we're at 6.67. So it actually ticked a little bit higher, a little bit of a rally today. But that was all kind of connected to the narrative. There wasn't a lot of data that caused this. It wasn't like new inflation reports freaked everybody out. It was basically just Fed speakers talking. And I'll get a little bit more into that in a second. Important dates. Next Friday, we got the April 28th PCE data for inflation. That's the Fed's favorite form. So we got to take a look at that. We want that to come in our favor to make the Fed back off a little bit. And then we got the BLS jobs report coming up on May 5th, Cinco de Mayo. May 3rd, though, is the Fed's next meeting. And right now, the markets have it at 86% chance that they will raise that they're going to raise another quarter of a point, and 14% chance that they won't raise. Now, playing poker professionally, I know that 86% odds don't always work in your favor, but in this situation, it looks like we're heading towards another hike. And we're just at that point, we're hopeful that they do their next meeting after that in June, they back off at that point. But this is all, like I said, narrative driven. We have a lot of different Fed chairs that have given speeches over the last week that are still banging that drum of war, still talking about inflation's too high, the job market's too hot, everything's great besides that, we can keep raising. Or the opposite side of that is we see a lot of inflation data is lagging and we see it coming down. We see that unemployment numbers are ticking up now. We see that job openings are ticking down. So, like I said, it's kind of a battle of the narratives right now. But like we've talked about before, all that really matters is what the Fed thinks about or thinks about everything. And right now they seem intent on raising again. And like everything shows, it seems like they might be intent. They're not going to stop until they see the job market really break a little bit. We don't want to see that happen. We'd rather see them, turn around the car before they get to that point. But, based on all these speeches, they are at least, letting everybody know that's kind of where they're headed. So, where does that leave us? Things are, still tight out there. It's still a really tight existing inventory. There's not a lot of homes for sale. So like we talked about before, when rates do come down, it's going to get super competitive. So if you have a borrower or a buyer that can't afford something right now and they find something they want, now might be the best time to buy because you could actually get in the house and not face so much competition. Whereas if you wait for rates to come down, then you're going to be facing a lot of offers, you're going to be facing a lot of more activity, and it'll be harder to get that house. And, like we talked about before, with rates, on the trend to come down in the long term, over the next year to 2 years, then, you get in the house now, you can afford it. Refi when rates come down. Don't wait for rates to come down because you might never get into that house to have the chance to refi to begin with. So if anybody needs anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Have a great day, everybody.